Hello and welcome everyone. This is Binam. In this short video, I'm going to talk about value at risk, and I will also show you the method that improves over value at risk technique. It is called conditional VaR, also known as expected shortfall. But first, let me talk about value at risk. If we find the result computed for a portfolio such as 7-day VaR at 95% confidence interval, if it is equal to 1 million, what we are saying there is at 95% confidence interval, which is 5% chance that losses will exceed 1 million in the next 1 week period. So what we are saying there is the interpretation of this finding is there is a 5% chance, or only a 5% chance, that the loss will be equal to or greater than 1 million in the next 1 week period. 1 week. That is the interpretation. Or if you think in relation to this diagram where you can see the tail of the bell-shaped curve, what you can say about this result is 5% of the time at 95% confidence interval VaR, what you can say is 5% of the time loss to be in the tail. Or what you are also saying is 5% probability that the loss to exceed the quantile. Now again, if you relate this interpretation mathematically with the volatility, then what you can additionally say is 95% of the time loss to be no worse than 1.645 standard deviation away from the mean. So again, what you are saying here at 95% confidence interval is 95% of the time the loss to be no worse than 1.645 standard deviation, no more than 1.645 standard deviation away from mean. That's what you can say. Of course, if it is 99% VaR, then it will be 2.32. Now, regarding the z-score, you already know from my previous videos that they are the numbers you can find from the table such as this, where you can see 1.645 is here in between these two, and the corresponding z-score value are 0.04 and 0.05, and on this side you've got 1.6, so that's basically 1.645 at 95% confidence interval. Of course, if you wanted, you can also make use of Microsoft Excel such that the Excel itself gives you the values that you found in the table. So at 95% confidence interval in Excel, what you are saying is the probability of the loss will be 1 minus this amount. So equal 1 minus the confidence interval gives you 5% and 1% respectively. And now what you can do is you can find out the Z for those alpha p-values, which are going to be equal norms I and V. Remember, in this formula here, there is S. The S is for standard normal distribution. So therefore, the probability is what you need to put, and you will get the answer, which is 1.645 and 2.32. Those two numbers exactly what I was writing before in the graph here. So that is on the VaR interpretation. Now let us assume that this bank has now given instruction to its traders. So people working, let's say in the treasury, has been and trading has been informed that the 7-day 95% confidence interval VaR is maintained. Let's use the same figure, is maintained and therefore not exceeded beyond 1 million. So if the bank gives this instruction that 7-day 95% confidence interval VaR is not to exceed 1 million, if this is told, then the traders may be able to achieve this, let's say as an example. So what will then happen? Trader may be able to achieve this, but remember, there is a danger. There is a danger that the trader will construct the portfolio where there is a 95% chance that the weekly loss is less than 1 million. However, remember, there can be 5% chance that the loss is 100 million. So although the instruction of the bank is maintained at 95%, so this is maintained, let me put it above here because it's a separate example now. It is maintained at 95% confidence interval, but let's say maintained, but it can be the case that in that 5% remaining, the loss, the probability of loss can be, as an example, let's say exceed 100 million. Okay, so if this happens, what does this mean? If this happens, this is simply telling us a situation like in this second diagram here, which is this one. So in both the diagrams here, the first diagram and the second diagram, the VaR is same, which is the VaR is 1 million, the value at risk. But as you can see in the case of second diagram, the VaR beyond the cutoff rate of 95% confidence interval is substantially higher, given by this rise here. So in such a case, what will happen? The common measure of VaR will not be able to capture the risk on the tail side. Therefore, the expected shortfall is a remedy, is a method that complements VaR and also overcomes the limitation of VaR. So that's what we are going to illustrate next. So basically what conditional VaR does is the VaR only gives you the quantile risk at the cutoff rate. It doesn't tell you, it doesn't talk to you about the tail side. Well, what conditional VaR does is it provides you the average loss from the cutoff point. So that's why the conditional VaR is the regulatory recommendation, because it captures more adequately the risk in excess of the VaR. Now, we may like to quickly define the conditional VaR. So, in terms of definition, the notation can be for conditional VaR or expected shortfall. The expected shortfall, let me use the pen and let me change this one as well. Expected shortfall or conditional VaR will be equal to expected loss, but condition is that the loss is already equal to or greater than the VaR at the uncertain probability alpha, the loss. So basically expected shortfall you will be able to measure for the condition that the loss is already equal to or greater than the VaR amount. Now in terms of formula, what you need to do is basically, as I said here in the diagram, you're capturing the average loss, average from this point onwards toward the left. So therefore, in the form of the formula, what you can do is expected shortfall will be equal to, in order to find the average, you will take, in the denominator, you'll put the alpha, and on the numerator, you can use the integral, and the alpha is here, and therefore you're simply saying value at risk, and this can be represented by gamma. Now gamma is basically the values beyond the alpha. So that's what the new symbol therefore we have used to represent the losses in excess of the one given by VaR, which is this alpha here, such that the losses are captured, and therefore you will put the gamma again here. So that is basically the expected shortfall formula here. But the as you can see here, the application is not complicated, and that's something I will be explaining quickly with the help of the example. And for the example, we would need to get some data, and the data I have is that from S&P 500, which I have downloaded using the Yahoo Finance, went to historical prices, and then I obtained the data for the last 101 days, and the data is here, just downloaded in the Excel spreadsheet. So as you can see, there are exactly 101 count. This means now I can find 101 trading, 101 return points. So for that, what I need to do, I will just remain very simple. I will just find out the daily holding period return, which is new share price, new S&P index price divided by old takeaway 1. So that is going to give me this number here, and I will just double click. So I've got all the returns computed. So it's here all the returns computed for 101 days, sorry, 100 days. So what I will do now, I will simply copy this and I'll paste it here, and this time I'll paste it as values so that the number won't change. So as you can see, it's formula here, but these are in values, no formula. Now what I will also do this time is I'll sort this in ascending order. Basically I'll start from the highest negative and will go all the way to highest positive. So these are my dates and this is my return from the S&P 500 index. So now what I'm going to do, as I said, I will be shorting them so that I get the values custom short, not on the basis of date but return and smallest to largest. So you can see the highest negative is appearing on the top, and you can also see these are exactly 100 data points. So you can see that it ends at 100. So now I have this. So what I would like to do quickly is to construct a histogram so that I can see the return in the graph. So one way to make the histogram is through a small manual intervention, which is to find the frequency. What we will do, we'll find the most negative return amount, which is this, and then we will take it all the way to the highest positive, which is this 0.02, which is 2%. So let me put it in percentage term as well, just for convenience. And then over here I will just say this will, let's say it will increase by 0.10, and therefore my job now is to take it all the way down so that I get to reach somewhere closer to this 2.20%. So 2.20% is somewhere here, 2.21, where I can stop. So I have made in a way the classification of the range of return. Now I will ask the computer to give me the return, for which I need to highlight all these area. Then I'll press equal frequency open bracket. I will go and select all the return and then select these range of return that I have created just now, which is called bin array, and then close bracket. I'll press Control Shift Enter, not just Enter but Control Shift Enter, and then now this is telling me how many times these returns have appeared here in my column H. So for example 0.0323 or simply 3.23% return hasn't appeared at all, so therefore this is getting a 0. So now what I will be able to do, I'll be able to construct a graph, and I will just take the column chart, and that's what I can see here. So what I will do, this graph, I'll put it in the top, will enlarge it a little bit in terms of view so that it is more visible for you all. So then we all know that this is frequency, so I'm deleting it and again deleting it here. And the last thing I'll do on this diagram is I'll change the 1, 2, 3 to the bin so that you know which column is representing which what percentage. So that's something achieved here now. So this is done in terms of histogram. histogram. Now what I will do, I'll find out the historical simulation given VAR, something we've done in the past as well, but here it's a nice thing to do at this point in time, because ultimately our goal is to compare the VAR with the conditional VAR. So over here I will just add one more column, and then you can see that I want to find out at 95% confidence interval the VAR first. So 95% confidence interval basically means the probability of uncertainty is 1 minus 95, that's 5%. Now number of days here is equal to 100. So that's again something in our mind. Now historical simulation given VAR will simply be equal to equal percentile. We can take EXC because this provides mathematically the precise percentile calculation in Excel. So therefore what we can do is we can take it from our return data array, comma, then we are saying this is at 5%, so close bracket, and we get the historical simulation given VAR at 95% confidence interval, which is this number here. Also we can convert it into percentage, 2.42%. Now what is this? Here we said days are 100, so in terms of VAR we're just saying fifth worst loss, fifth worst loss, or fifth worst day as well, you can say. Now purposely I had taken 100 daily return so that it's easy for you to understand that we are looking for the fifth worst day. So you can see here that when you can see here in the return which we organize in the order, the fifth worst day is also equal to this number here, so they both are same. In other words, what we can also say is it is also the fifth smallest return, given there are 100 returns. So you can do equal small open bracket in your data point here, you can highlight them all, and 5, small 5 will also give you the same, which is in percentage term again the same, 2.42. So you see, this is what we learned through historical VAR. Now where is this 2.42 in this diagram can be your concern. So here 2.42 is after 2.33 but before 2.53. So let us sketch a line there just to allow us see where exactly it lies. So that's 2.42, which is somewhere here. So I have it now, 2.42 here, and I'm going to color it, let's say orange, and let me thicken it by assigning a higher weight, and that's what I have just done. So that is the point of historical simulation given VAR. Now here we want to relate it with our understanding of expected shortfall, which is basically the average value at risk subject to those value at risk that have already exceeded the given cutoff rate value at risk, which then basically means over here what we are looking for is, in terms of conditional VAR, or also known as expected shortfall, is equal average of these 5 worst losses, 3, 4, 5. So that's going to give us CVAR, which is 2.97%. So again, in the in the form of the diagram, where is it? So what we will do again, we'll insert a line just to identify that point, which will be somewhere here. So again, I'm going to create a line for that 2.97%, and let me color this, and this time I will color it, let's say, black, and then I'm going to thicken it a little bit so that it's visible better. Okay, so I have now this for the common VaR, traditional VaR given by historical simulation, but this one is CVaR, or also known as expected shortfall. So what has happened here is similar to the explanation here given by this diagram. VaR is at the cutoff point, whereas CVaR is the average of the losses beyond the cutoff point. That's what we have been able to find. Now, very quickly, if you see this histogram, you can already make some idea that this is skewed towards the left. What we can do, we can quickly make that here, which is, for which what we can do is just make a line like this, and therefore let me do it once again, which is, let me delete it. It's a bit tricky, but then should be fine this time. Let's see. So if I'm making this, I need to go all the way here. Okay, one last go, which is what I'm going to do again, so that I'm able to construct this similar to a curve. So insert illustration, shapes, and then I'm going to take this. Now I am using the mouse, and I want to show that this is very much a negatively skewed diagram. So that's what I have done, and you can see here, or what I can also do is just to show you, delete this, so you can see this is negatively skewed. So that's something you will be able to find if you find the skewness, which is equal SKEW, open bracket, all of your returns, which is here to here, close bracket, and this is, as you can see, if it were 0, it would mean symmetric or bell-shaped curve, but it's a lot higher than minus 0.5 even, so this is negatively skewed. So in such a case, you have been able to see that the VaR given was 2.42%, but the conditional VaR is 2.97%. Assuming there was an investment of, let's say, 100,000, then the VaR loss amount would be 242 for the next 24 hours, given by the historical simulation VaR, which according to conditional VaR would be 296. So you see there's a big difference between the loss reported here and the one reported, which is the average of the losses beyond the cutoff rate, which is this point. Now, let me tell you once again, I have applied this CVaR in the context of a portfolio which has 5 different stocks. Again, this is from the real world data, and this example already computes the CVaR or conditional VaR. I just want you to pay attention here on the fact that the number of days in this particular example of 5 different companies, 5 different stocks, is 1243 days. Now these 1243 days in terms of the CVaR computation, when we are taking the average for 99% confidence interval, it will be 1243 times 1%, therefore 12 days. So 12 average of the 12 worst days losses is important, which in this example becomes this number here. In the case of, let's say, 95% confidence interval, 5% is the uncertainty, therefore 5% times 5% times 1243 times 5% gives you the 62. So what you therefore do in order to find out the conditional VaR is you go here, you type in average, open bracket, you need to go all the way to 60-second. So here all the way down to 60-second worst losses, and that's here, and you close bracket and you get that number. And assuming you had, let's say, invested 100 million, then you multiply this to find out the CVaR in dollar. So you see the CVaR is 2.98, whereas the VaR is only 1.99. You see the big difference it makes in terms of the expected loss amount. Hence, what you can say is CVaR talks about the loss on the tail side, whereas the VaR stops at the cutoff point. VaR only talks to you about the loss that it will only talk about the loss to exceed the quintile, or the percentage of the time the loss to be on the tail, whereas CVaR gives you the average loss from the cutoff point and beyond. So it takes the average of all the losses from the cutoff point. So that was a quick illustration on conditional VaR, in which we mainly use the data of S&P 500. I intentionally took 100 days data so that it's clear to you that historical simulation VaR at 95% basically means the fifth worst day outcome. That's something we're able to see here. Or it also meant fifth smallest return. Again, that was also giving the same result. But when it comes to conditional VaR, what we need to take is the average losses after the cutoff point, which in this case was given by 95% confidence interval. So the average loss therefore will be the average of the 5 worst losses. So therefore we took these numbers here, so we therefore averaged the 5 worst losses. So students who are locally based, you will be able to find all my materials through access to Blackboard site. Students from abroad who are based abroad these days, you will be able to find the materials inside Banks and Markets. Just click finance, as I said. So that's all about conditional VaR in my discussion. The very last thing I would like to say is about the traders who were punished because of the fact that they undertook trading activities that were not authorized, and therefore they faced legal consequences. The central question here is, can a can VAR, the risk estimate measure VAR, help resolve such a problem created by or likely to be created by the rogue traders such as Nick Leeson of Barings Bank and Jerome Carvel of Société des Journaux of France? The answer is, they are operational risk, they are the misconduct of the traders. This will not be captured by value at risk. However, these are interesting stories, and I've captured here the movie of Nick Leeson. So you can click here to watch the movie. And the second item here is you can see here Nick Leeson and all the story about the collapse of Barings Bank. So here you will also see Nick Leeson himself talking. But on the whole, what I would also like to say is, how good is VAR? Can VAR help us overcome the risk such as those we faced during the financial crisis? Again, the answer is, it will not be able to capture extreme events. Therefore, there are new concepts such as bubble value at risk. However, what we can say for sure is the method that we just discussed, expected shortfall or conditional value at risk, minimizes the limitation of the popular method such as variance covariance, historical simulation, and Monte Carlo simulation given value at risk, simply because it does not, the expected shortfall does not stop at this cutoff rate. It doesn't stop here, cutoff rate, which is the line here given by this orange. It takes into consideration all the tail risk and gives you the average. However, once again, it is important to understand what is there beyond the average is again something we need to see more carefully. Of course, the average is already capturing all these losses. So this is all from me today on the conditional VaR. Thank you very much for your time, and thank you very much for listening.